Folks, insurance companies are literally fleeing entire states right now while builders are cutting prices by 27%. And if you don't check your zip code before your next renewal, you could be in for a massive shock. I'm going to show you exactly which insurance companies just abandoned which states, why builders like Lennar are slashing prices by over $100,000 per house, and most importantly, the specific zip codes where your insurance is about to get canceled or become completely unaffordable. But here's what nobody's telling you, and this is the part that's going to save you thousands of dollars. There's actually a way to use this crisis to your advantage if you know which markets the smart money is targeting right now. We've got the data on exactly where builders are so desperate they're offering 0.9% mortgage rates and throwing in $60,000 cash incentives just to move inventory. And the third thing we need to tell you up front, this crisis isn't just about Florida anymore. We're going to show you insurance withdrawal maps from Texas, California, and Arizona that prove this is spreading to markets where people think they're safe. But if you check your zip code right now using the method we're about to show you, you can actually get ahead of this before your next renewal hits. Look, we've been tracking housing markets for years, and what we're seeing right now is unlike anything we've witnessed since the Great Recession. This isn't just a regional hiccup or some temporary market adjustment. This is a fundamental reshaping of how homeownership works in America, and it's happening right under our noses while most people are completely oblivious to what's coming. Let me tell you what just happened that's sending shockwaves through the industry. State Farm, America's largest home insurer covering 2 million homes in California alone, just delivered a knockout punch to the Golden State's housing market. They stopped accepting all new property insurance applications after the January 2025 Los Angeles wildfires hit them with over $7 billion in direct losses. When California's insurance commissioner denied their emergency rate request in February, State Farm essentially said they're considering a complete exit from California. We're talking about 20% of California's entire insurance market potentially disappearing. But here's where this gets really interesting and connects to what we promised to show you about builder price cuts. The insurance exodus isn't happening in isolation. It's creating a domino effect that's forcing home builders to slash prices just to find buyers who can actually close on transactions. Lennar's CEO Stuart Miller just acknowledged they're giving away an average of $62,800 per home in incentives and price adjustments. That's 14% of their average sales price. They're essentially paying buyers to take houses off their hands. The numbers are staggering when you look at the actual data. Lennar's average sales price crashed from $491,000 in 2022 to $386,000 in the fourth quarter of 2025. That's a $105,000 collapse in less than 3 years. D.R. Horton, the nation's largest builder, is now offering 3.99% FHA loans when market rates are above 7%. They're literally buying down mortgage rates just to move inventory. Now, let me resolve that second promise about where this crisis is spreading beyond the obvious markets. Progressive Insurance completely halted new homeowners policies in Texas after storms caused 40% of their second quarter 2024 losses. Farmers Insurance exited Florida entirely in July 2023, abandoning 100,000 policyholders overnight. But here's what shocked us when we dug into the data. Arizona homeowners are being rejected by up to 22 insurance companies before finding coverage. 22 companies saying no to the same homeowner. The premium increases are beyond anything we've seen in modern history. Florida homeowners are paying 148% more than the national average. We're talking $5,800 to $7,100 annually for basic coverage, but in places like Fort Lauderdale, it's nearly $11,000 a year. That's almost $1,000 a month just for insurance. One Texas homeowner told me his premium went up 22% in 2023, 39% in 2024, then 78% in 2025. His insurance costs more than doubled in 2 years. California premiums appear lower at around $1,600 annually on average, but that's completely misleading. Wildfire zone properties are seeing premiums 10 times higher, with Malibu and Napa homes paying over $3,000 annually when they can get coverage at all. Many are simply being rejected outright. Here's where we get to that third thing I promised about the massive opportunity, and this is where smart money is making moves right now. Builders are sitting on 121,000 unsold completed homes as of July 2025, the highest inventory level since July 2009. But new construction actually carries lower insurance costs than older homes because of modern building codes, impact-resistant materials, and newer roofs. Let me give you the specific markets where this opportunity is playing out. Cape Coral, Florida, has seen home prices drop 7% year over year and 13% from their peak. But it also has the third highest premium to home value ratio in the country. Austin, Texas has 114% more sellers than buyers, the largest imbalance in the nation. 53.4% of listings have price cuts. Phoenix shows 48.99% of listings with price cuts, with median prices dropping from $465,000 to $445,000 in just 5 weeks. But the real story behind these numbers is what's happening to actual transactions. 47% of people who bought or sold homes in 2024 experienced insurance difficulties, and 21% saw their transactions fall through entirely because of insurance issues. California saw 13.4% of sales collapse due to insurance problems, nearly double the previous year's rates. When buyers can't secure standard insurance, lenders impose what's called force-placed insurance, which costs 2 to 3 times normal premiums and covers only the structure. One Florida homeowner got hit with a $4,400 annual premium for just $150,000 in coverage. Legal experts are saying force-placed insurance is becoming the primary driver of mortgage defaults. The scale of this disruption became crystal clear during the October-November 2025 government shutdown when the National Flood Insurance Program froze. 1,300 home sales per day were lost nationwide due to unavailable flood coverage. Houston alone saw 15% of pending sales collapse in the final months of 2025. These financial pressures are driving migration patterns that are reshaping American demographics. Florida's net domestic migration plummeted 49% from 2022 to 2023. A Florida Atlantic University survey found 50% of Floridians are considering leaving due to rising costs. California just overtook Illinois as the top outbound state for the first time in a decade. Some state governments are fighting back with meaningful reforms. Florida's 2022 tort reforms eliminated attorney fee abuse and assignment of benefits problems. The results are impressive. Property claim litigation dropped 25% in the first half of 2025. 12 new insurers entered the market, and Citizens Insurance actually requested a 5.6% rate decrease for 2026. California's insurance commissioner now requires companies using catastrophe modeling to write at least 85% of their statewide market share in wildfire-prone areas. Mercury, Allstate, and CSAA announced expansion plans after the state approved these new models in July 2025. At the federal level, we're seeing a complete philosophical shift. President Trump stated in June 2025 that his administration wants to wean off of FEMA and bring it back to the state level. FEMA could be eliminated or dramatically restructured by December 2025, with proposals to quadruple disaster declaration thresholds and cap federal cost shares. So what does this all mean if you're looking to buy in 2026? New construction buyers are securing mortgage rates averaging 5.27%, a full point below the 6.26% average for existing homes. Builders are essentially subsidizing $60,000 plus per buyer through rate buydowns and incentives to move inventory. But you absolutely must factor in the insurance equation. A $400,000 new home with a $60,000 incentive package looks attractive until you realize a $12,000 annual insurance premium versus $4,000 in a stable market adds $8,000 annually to your true ownership costs. Here are 3 actionable insights from this data. First, new homes in high-risk areas actually cost less to insure than older properties due to modern construction standards. Second, transaction cancellation rates hit 14.3% in January 2025, the highest January level since 2017, giving informed buyers significant negotiating leverage. Third, markets with the steepest builder price cuts directly correlate with insurance market disruption, meaning properties may stay depressed until insurance availability stabilizes. The critical insight for 2026 is recognizing these aren't separate problems but interconnected feedback loops. Builder price cuts happen partly because buyers can't qualify when insurance costs push debt-to-income ratios over lending limits. Insurance withdrawals accelerate in markets with mounting claim losses, from aging housing stock and climate events. For anyone considering Sunbelt real estate in 2026, insurance availability must be your first analysis, not your last. Those 121,000 unsold new homes represent genuine opportunity, but only in markets where insurance is stabilized. States implementing real reform like Florida's tort changes and California's coverage requirements will likely outperform those where the crisis remains unaddressed. This perfect storm isn't ending anytime soon, but for informed buyers with cash reserves and long investment horizons, the intersection of desperate builders and distressed insurance markets is creating buying opportunities we haven't seen since the Great Recession. If you can secure the insurance, make sure to research the specific market data for your zip code before making any decisions. And if this analysis opened your eyes to what's really happening in today's market, hit that subscribe button because we're tracking these interconnected trends every single week as this story continues unfolding. Thanks for watching, and we'll see you next time.